It is now my pleasure to turn today's program over to James Arnold, Director, EMEA Business Development. James, the floor is yours.
Thank you very much, Rebecca. Hello, everyone, and welcome to the ClearBridge Investments Anatomy of a Recession update. My name is James Arnold, and with me on the call is ClearBridge's Chief Investment Strategist, Jeff Schultz. As many of you will know, Jeff's strategy team provides economic analysis, which serves as a valuable context for our portfolio managers at the firm. The Anatomy of a Recession research, which we'll run through today, concisely tracks the potential for the US economy to fall into and emerge from a recession. There are two dashboards, the Recession Risk Dashboard and the Recession Recovery Dashboard. Both have a traffic light system to indicate improving or worsening signals. At the time of our call last quarter, the dashboard was clearly signaling that the US economy was in a recession, and in June the economy appeared to be close to a bottom, but green shoots were appearing. So where are we now? What does the recovery dashboard tell us, and what should we be looking for going forwards? We'll hear about this over the next 30 minutes, at which point Jeff will answer questions. We'll try to answer as many of these questions as possible after the prepared comments. You may have also noticed a poll question on your screen. How much of a retracement will the S&P 500 experience in 2020 from last night's close? Your selection will be anonymous, so please feel free to express your views, and we'll share the results of the poll later on in the call. But without further ado, welcome, Jeff. We're very eager to hear your thoughts.
Great. Thanks, James, and thank you, everybody, for dialing in here today. And obviously, it's been a wild ride in 2020 so far. You know, if I had said at the start of the year that the U.S. economy was going to lose 40 million jobs in the space of 4 months, and the the NASDAQ would be up 17% year to date, you probably would have thought I'd lost my mind. But obviously, that's exactly what has happened, and it just goes to show you how difficult it can be to predict things in this business, especially when you have a true black swan like a global pandemic. So we've had essentially 4 years worth of price action take place over the course of the last 4 months. And the key question, in my opinion, is where do we go from here, both from an economic and a market perspective? Now, in the latest long view, which is my quarterly macro and market white paper that we put out, I talked about a common paradox. What happens when an unstoppable force meets an immovable object? And in this case, the unstoppable force is the tenacious determination of our policymakers to avoid falling into the next Great Depression. And the immovable object is a U.S. economy that remains really fragile because of several headwinds, like obviously the continuation of the first wave of infections, an extremely weak labor market, a likely surge of bankruptcies, and then also a consumer who's hesitant to re-engage with the economy. And so far, the market appears to be giving the unstoppable force the edge, but it's way too early to decide who has won the war, because the real economic impact is only going to start coming into focus after the initial burst from the reopening that we've seen. But before I dive into that, I want to talk about the recovery dashboard and what our thoughts were at the beginning of last quarter. So at the time, we'd assumed that it was going to be a traditional playbook of counter-trend rallies and a retesting of the market lows that is going to play out, as the V-shaped bottom is not the traditional method of forming major market troughs. And in fact, if you go back to 1950, for example, there's been 15 bear markets, and out of those 15 times, the market has retouched or broken its low 14 of them. Maybe said a little bit differently, the V-shaped bottom is not the odds-on favorite. And of course, during this recessionary process, there's a lot of false starts along the way, better known as counter-trend rallies or suckers rallies. And it was a key assumption that was underpinning the recovery dashboard. And you can see that the counter-trend rallies that you've seen over the years have historically gotten bigger. On the right-hand side, you can see all the counter-trend rallies for the great financial crisis. They can be quite long as far as time is concerned. That third one lasted 51 days. And they can be quite robust as far as magnitude is concerned. The last one there was 24% between November of 2008 through January of 2009. But obviously, when the economy continued to falter, you saw the markets roll over, eventually hitting that low in March of 2009. And, you know, counter-trend rallies, it's just really the natural phenomena in the process of price discovery. So this process was short-circuited, unfortunately, this time, because policymakers were given unique visibility in not only the size of the recession, but the duration of the recession. And they were able to respond aggressively and combat economic weakness to stave off a financial meltdown. Now, this recessionary certainty never really occurs in real time, but it did this time, and policymakers didn't disappoint. So if you look at the Fed, for example, they moved at the speed of light. It took them weeks this time, what took them quarters back during the great financial crisis. And the Fed was so determined to quell the liquidity crisis that it did QE on steroids. In the span of 4 months, the Fed brought its balance sheet from $4 trillion up to $7 trillion. And this is truly a massive amount of liquidity in a short period of time. And maybe to frame this, if you go back to 2013 and QE3, which was the biggest bond buying program in the post-GFC crisis, the Fed was purchasing $85 billion per month, and they did a total of $1 trillion that year. So basically, the Fed did 3 times the amount of stimulus today in 1/4 of the time. And of course, a lot of this excess liquidity made its way into risk assets. Now, it's importantly, if you look at this chart, you can see that the QE is going to be lower for the rest of the year. Powell has said that he's going to put a floor of QE of $120 billion per month, 80 of which is Treasuries, 40 of which is mortgage-backed securities. But you can see that Treasury issuance is going to be almost double that at around $225 billion per month. So you're actually seeing a net drag of liquidity for the remainder of the year. So that means even though you've seen these easy gains off of the lows, because a lot of this excess liquidity is going to be much more a grinded or measured approach as we move forward. Now, the other side of the equation, obviously, is what global policymakers did from a fiscal stimulus perspective. Congress put over $3 trillion of stimulus into the system, and those funds were distributed to small businesses and individuals in record amounts of time. Now, I was a little reluctant on how quick the stimulus would hit individuals and small businesses, because if you look at the 2008 and 2001 recession, it took them 3 months to get checks to individuals. 3 months in this type of environment would have been catastrophic for the economy. Obviously, they used direct deposit lines to get stimulus into people's checking accounts, and the PPP program went out in the mere couple of weeks rather than months than I was anticipating. So obviously that was a key to be able to backstop the economy. But also you can see here that European stimulus was even more impressive, as Italy and Japan and Germany are approaching 50% of GDP through all of the stimulus that they put out there. Now, maybe to frame it differently and look at U.S. stimulus in a different perspective, if you look at the Marshall Plan that was used to rebuild Europe after World War II, that cost around $140 billion in current dollars. The Vietnam War, the entirety of the Vietnam War, cost around $1 trillion in today's money. So if we assume, and I know you really don't want to assume much in this business, but let's just assume that we get $1 trillion in a stimulus package later this summer from policymakers. The recent COVID crisis in the U.S. is going to cost closer to $4 trillion on the low end. That figure is 29 times the size of the Marshall Plan, and it's 4 times the size of the Vietnam War. This obviously is a startling amount of intervention over the course of 4 months, and obviously is the big reason for the move behind equity markets during Q2. But there's another dynamic that helped usher in this huge amount of stimulus, which is political cover. Now, just over a decade ago, obviously, Wall Street banks were blamed for the financial meltdown, and it was really politically unpopular to be able to bail out the banks. And because it was politically unpopular, it took a longer time for that stimulus to be distributed, but more importantly, the stimulus probably wasn't as strong as it should have been if it was something that was more politically popular. This time around, there's no one to blame for COVID-19, right? And someone being on unemployment shouldn't be blamed because the virus hit our shores. If a business shuttered their doors, again, it's not their fault. So they have political cover to be able to act swiftly and, more importantly, aggressively with a lot of the debt that's been taken on. Now, more importantly, as you move forward, I think that this is a unique situation given the foresight of the recession, of both the timing and the magnitude and the political cover. I don't think that this dynamic is going to be the playbook as we move forward. And I think more as we have the next recession, next recovery, you're going to see that more typical experience of a longer recession with counter-trend rallies and a retesting of the lows. But I clearly underestimated the powerfulness of this backdrop back in April. I thought we were just going through a counter-trend rally. But nonetheless, I always think it's helpful to talk about what our thought process was back at the time and what's changed to really challenge our thesis. And the irony is that with the entire narrative, we were spot on with our narrative on what was going to happen to the economy, but the market's reaction surprised us a little bit. So let's talk a little bit about the recovery dashboard and what has happened here recently. So just as a reminder, the dashboard is a group of 9 indicators that have historically done a good job of being able to foreshadow a durable economic and market recovery. The stoplight analogy, meaning you go from recessionary red to a yellow improvement all the way to a green expansion. And if you look at the left-hand side of the chart there, you need three things for that durable recovery. You need confidence, and we look at confidence across a myriad of different areas: consumer, business, investor confidence. If you have broad-based confidence, obviously a recovery can take place. Below that, we look at economic green shoots. We need to obviously see some positive activity on the economy. And then lastly, we need to see a turnaround in financial conditions and financial markets in order to be assured that the recession has ended and a recovery has begun. And you see in April, we are overall a red signal, moving to a yellow improvement in May, and then a overall green signal at the end of June. So we now do believe that we have a durable economic and market bottom at this point. Now, what I'll say is if you look at the last 7 recoveries that we've had, on average, the dashboard has turned green 1 month ahead of the end of the recession. So it tends to be a little bit earlier from the end of the recession call. From a market bottom perspective, it on average has turned green 1 month after the market bottom. So it's a little bit later to the game in order to avoid those counter-trend rallies that we talked about. Now, thinking about what we've just experienced, we think that the end of the recession likely happened in May or maybe June of the second quarter, given the mechanical shutdown and reopening of the economy. So we think that we're a little bit late to the game on that front. But from a market bottom perspective, we're 3 months after the bottom, again, because of the insight that policymakers certainly had. But nonetheless, we've had an overall green signal, and we think that the durable market and economic bottom has occurred. Now, obviously, the million-dollar question here is what's the shape of the recovery and what's going to happen in financial markets? So if you think about the shape of the recovery, we think it's likely going to be a U-shaped or a backwards J-shaped type of recovery. Now, you obviously have seen as the initial economic thrust off the lows, it surpassed consensus expectations, but I think the truth is going to come in the middle, in the back half of the third quarter into the fourth quarter as well. Obviously, many states are slowing. In a lot of cases, they're reversing the reopening plans due to the increase of coronavirus. Right now, half the population lives in states that have either reversed or paused the reopening. And this was a core view of ours back in April, is that we thought, given the piecemeal approach, the state-by-state approach that the U.S. took in order to initiate lockdowns versus the nationalized approach that you saw in countries in Europe and China, we're going to have a much more difficult time being able to quell the first virus wave. And obviously, you've seen that explode to the upside here recently. More importantly, if you look at the South and the West, they make up about 35% of our GDP. But we think that that's going to be offset the weakness that you'll see in the Northeast and the Midwest, creating a stable but more importantly, not an accelerating economy from here. Now, a lot of these increase of cases can be attributed to better testing, but you are seeing the percent positive tests starting to increase in a lot of these hotspots, which means this is genuinely starting to spread. Now, the key here, even though you are starting to see some of the regional activity start to grind lower, if you look at Open Table, for example, Home Base, the Dallas Fed Mobility Index, you are starting to see activity move slower. But it's not going to be as disruptive as what we saw in March because you are going to see maybe pockets of the economy shut down, but it's not going to be a nationalized approach. But as we enter into August and September, as the school year starts to start, people go back to work, it's going to be difficult for the South and the West to go back into work in a normal fashion, especially considering if the education sector makes a move to shut down the schools, that informs other areas like daycares, sports, nanny agencies, things like that. And if you don't have the child care options, it's very tough for people to reassimilate back into full-time jobs because 40% of American households have a minor child at home. Obviously, on a positive note, you are starting to see mandating face masks in Texas. About 24 states now mandate a face mask. I hope that other states will move in that direction to help quell the move that we're seeing here with infections. But obviously, this leads to another issue, which is what the spread of COVID-19 is going to do to consumer behavior, especially older generations. Now, recent cases have been concentrated among younger adults who are obviously testing the waters given the lower fatality risk that they have. But I'm actually more concerned with older individuals, people who are over the age of 55. They make up over 40% of consumer spending in the U.S. If you put that differently, it makes up about 28% of the overall U.S. economy. And this cohort is going to be very hesitant to spend until there is some sort of medical advancement or a vaccine. And if people are more apprehensive to spend, obviously this creates a situation where even though a liquidity bridge has been brought out to companies and individuals in Q2 and Q3 from policymakers, you could have a solvency issue as you enter into Q4 and also into Q1 of next year. And this is going to disproportionately hurt Main Street, right? Wall Street has been given access to capital, right? You've had record issuance there the first half of the year. But that's more importantly, the nature of the businesses on Main Street are much more close personal interaction types of businesses. And unlike manufacturing, retailing, and agriculture, services businesses can't hold inventory, right? There's no second chance to sell that hotel room or that haircut or the restaurant meal. And if people don't reassimilate back into the economy and fully reengage, even the best run businesses can't maintain that rate if the revenues are 50, 70, 80% of where they were pre-COVID-19. So getting consumers to reengage with the economy is going to be key on how far the economic weakness will go. But if you do start to see some bankruptcies, it's really going to weigh on the labor market. And obviously one of our core views last quarter was that because profit margins were stretched for the U.S. economy, it was actually a recessionary red in our recession dashboard. We felt that businesses were going to cut their workforce much more freely, and it was going to create a situation where you're going to have an overhang in the unemployment situation. And this is clearly evident. Even though you saw a very good jobs number from June and May, jobless claims are still extremely elevated right now. Now 16 weeks into this crisis, right? We're 3 months into this crisis. This isn't because businesses are forced to shut down. It isn't because people can't get access to the unemployment benefits at the state offices. 16 weeks into this crisis, initial jobless claims are running at 1.3 million. That's almost twice the previous record that we've seen back in 1982. That's a huge number at this point in the recovery. And it's important to realize that a lot of these layoffs are going to be permanent because, again, people have already reopened their doors. Now, with 1% of the workforce being laid off on a weekly basis, this could be a sign of trouble that a lot of small businesses are having trouble staying solvent, but also a lot of larger businesses are starting to cut back on their workforce because of the margin issues that I talked about before. Also, continuing claims remain stubbornly high. Yes, they're down from 22 million from a month and a half ago, but we're still at 18 million, which, again, toward our view 3 months ago, we think that the joblessness situation is going to be an issue as we get further along into 2020. Now, one thing I want to do is I want to talk about some data sets that could be helpful in being able to point us into not only the future of the economy, but the future of the markets as well. Now, one interesting dichotomy that I've found is that the 10-year Treasury is not singing the same tune as what you're seeing with equity and credit markets. Obviously, equity and credit markets have clearly moved to the upside because of the backstops that we talked about before, but Treasuries haven't shown any amount of optimism. Now, Treasuries, ironically, were the canary in the coal mine at the beginning of this year. You can see that Treasuries started to drop in January and February, well before the equity markets rolled over at the end of February. And this time around, they've been in a very narrow trading pattern. Will they even break 1% with the reacceleration that you saw in the very beginning of June? So the key question here is, are Treasuries foreshadowing material economic weakness that equities are ignoring right now? It's hard to tell at this point. Again, I think we're going to have a lull in economic activity as we get to the dog days of summer, but it's something that I'm watching fairly closely. Other things that I'm watching pretty closely is obviously the credit markets. Now, ironically, with double-digit unemployment numbers right now, IG yields are at all-time lows, and spreads have retraced a huge portion of the widening. This is clearly a byproduct of the Fed's backstop, but it's remarkable considering the weakness and the speed bumps that we see ahead from here. But also, you're also looking at inflation expectations in the dollar. And I want to talk about the dollar first. Right? The dollar peaked when dollar swaps were established with almost every single central bank that's out there. Ironically, the only central bank that was not included in the dollar swap lines was the PBOC over in China. But in any event, a weakening dollar has been key in loosening financial conditions, not only in the U.S., but globally as well. And if you look at the Fed's balance sheet, all of those swap lines are basically at zero at this point, which says that there are no dollar funding issues. That's a really good sign for the health of the global economy, and obviously earnings here in the U.S. and the S&P 500 that have a lot of international exposure. The other area that we've been watching really closely is five-year inflation break-evens. It's a key metric in being able to determine what the market's perception is on the effectiveness of both Fed and congressional actions. Now, right now it's around 1.55%, which it's not where we were coming into the crisis. When we were coming into the crisis, it was about 20 to 30 basis points higher, but it's well off the lows that we saw. And it's a good sign that the economy is not going to go and falter dramatically like the 10-year Treasury is saying. But again, we are looking at some slower weakness and a longer grind, economically speaking, as we move forward. So kind of given this view on a bumpy economy, a kind of a choppy ride moving forward, it brings us naturally to the first question that I'm sure are on a lot of your minds is what's the first pullback going to look like? So we looked at the first pullback after a major market low since 1957. The average pullback that we saw was 9.3%, and it was 26 days. Now, obviously, given the magnitude and the speed of the rally that we've seen here, I wouldn't be surprised if it was on the higher end of this range, maybe 10 or 15%. But nonetheless, we are probably reaching a point where you're going to have a pullback shortly. Now, how big this pullback ultimately gets, I think is contingent on both support from Fed and Congress. What type of support can we get going forward? And I'll talk about Congress really quickly. Now, right now, over 30 million individuals are receiving unemployment benefits. And prior to the crisis, the nationwide weekly unemployment benefit was around $375 per week. Now, Congress, with the CARES Act, they topped another $600 per week on top of that. Well, that's set to expire at the end of July. Now, of course, some of these funds have been saved. There was a key reason why you saw the savings rate spike up a couple of months ago, and it still remains elevated. But if you eliminated this benefit completely, it undoubtedly would lead to a decline in consumer spending. So we think, obviously, more fiscal support is warranted, but you are running into a situation where you could see policy fatigue, right? The markets are at almost near record highs. The markets are acting very, very healthily. If Congress gets complacent, I think that would be a huge mistake. And I don't think you'll see a full expiration of these unemployment benefits because that would be political suicide for the Republicans heading into the election. But the key for the economy is how much of those benefits are reserved. I think you need at least $250 or $300 on top of the state unemployment benefits, at least to keep consumer spending trends, retail sales, consumer confidence, all at levels that they've been at here to keep the economy moving forward. In that same vein with the congressional package, I'm really looking to the PPP program and the Main Street lending programs. They need to, A, be extended, but B, they need to be easier to access. Small businesses that have been the hardest hit from this pandemic need to be able to access that program 2, maybe even 3 times. Areas like hospitality and leisure, for example, people that are businesses that are going to have a difficult time renormalizing their business until we can get a vaccine out there. So if we can get these 2 key things in the package, I think this would be positive for the sustainability of these market gains. But again, it's far from a foregone conclusion that you're going to have this happen come late July, more than likely early August with this new package. But at a minimum, I think we need $1.5 trillion of support. The other half of the equation is obviously the Fed, and Powell has not declared victory yet. He has, on numerous occasions, said that there's a lot of difficulties that lie ahead, and he might have said the most dovish thing I've ever heard a Fed chair say. He said, we're not even thinking about raising rates. I mean, a statement like that makes Janet Yellen and Bernanke look like Paul Volcker, and that's saying something because Bernanke and Yellen were extremely dovish. He's put a floor on QE of $120 billion, but he also was asked, and I'm not sure if any of you caught this, but he was asked about, was he concerned about a potential asset bubble? And Powell replied that the principal focus is on the state of the economy, the labor markets, and inflation. I'm not going to read you the quote specifically because it's much longer and much more convoluted, but it was a clear sign that the Fed is going to keep its foot on the accelerator until we see a substantial improvement in the labor markets. The Fed, maybe an indication of this is the Fed has continued to buy corporate bonds, again, even despite narrowing corporate spreads, and then IG yields at record lows as well. So again, this has important implications. If you have diminished solvency risks because of the Fed backstop, that translates into higher equity multiples. And again, the Fed is going to support the economy, create jobs, and they don't care about inflating an asset bubble at this moment. So if that's certainly the case, and maybe we have more upside for the market to come here, because usually when you have the strongest 50 trading day rallies, strength begets more strength. And what I mean by that is the strongest rallies we've seen since the 1970s, if you've had a V-shaped recovery, a big move in the market, 6 and 12 months out from that point, the markets are up 100% of the time. On a 6-month basis, the markets are up 9.5%, and on a 12-month basis, the markets are up closer to 17%. So It's important not to get too bearish at this point, and history would suggest actually more upside for the markets to come. So it actually kind of brings me to kind of my closing thoughts before I turn it back over to James. What's the call? So the markets, they've come a long way in a short period of time due to the once-in-a-lifetime foresight that policymakers into not only the depth of the recession, but the timing of the recession. They had the political cover to open up a blank checkbook and allowed them to act swiftly and aggressively to stem the tide of this recession. Powell's been extremely direct in his messaging on the lengths that the Fed will go to support the economy and that limit solvency risks, at least for the larger companies that have access to the Fed's lending facilities. One thing that concerns me is the risk of policy fatigue with the next fiscal package. I don't think policymakers will be complacent, but we do have the potential for that to happen given where markets stand at this moment. Again, I think it would be a mistake because I think the economy is moving into a neutral stance rather than continuing to reaccelerate. But nonetheless, that is a risk that I'm looking out for. Now, if you think about recessions, they typically drive negative feedback loops. You have weak corporate profit margins, it leads to soft labor markets and weak demand, and usually these dynamics build upon themselves and they infect otherwise healthy portions of the economy. And a lot of times this weakness has persisted beyond the recession itself. And that brings me to a point that it poses risks to the 2021 earnings and the potential valuations that are embedded into equities. Now, if you look at analyst dispersion on estimates right now, they're at the highest levels since the great financial crisis. And as a consequence, a lot of them are treating this as an average recession due to the lack of visibility right now. And obviously, if you have a lack of visibility and you have a deeper recession that's anticipated, if that E number needs to come down, that's certainly going to affect what the valuations of the market will be at. But the key here is that Fed and Congress continue to have the back of the economy and Main Street. And it's obviously the reason why we've seen a disconnect between markets and the economy. How does this get reconciled? I think the market is due for a correction. I think it would probably be in the 10 to 15% range. I think the catalyst is the realization that the economy's reboot is starting to lose some momentum over the next couple of months, and the additional realization that the labor market is continuing to see massive job losses, and a lot of businesses, quite frankly, aren't going to make it. So I think the market's going to be range-bound. I think it's going to be between 2,700 and 3,350 over the next 6 months with a modest bias to the downside. Where could I be wrong? A white swan. I mean, look, if you see the headlines this morning and why the markets are up, Moderna has some really good data. Oxford has a really good article on Bloomberg. Maybe we get a vaccine or therapeutic development quicker than it's currently anticipated. And they're already starting to manufacturing 4 of the best candidates at the end of the summer, so you can get vaccines out quicker, assuming they can pass all of the phases that they need to in order to get approval. Maybe the virus burns out on its own. If you look at the Spanish flu in the 1918 to 1920 range, it naturally burned out. Obviously, there was no vaccine there. Maybe consumers normalize faster. Maybe the labor market heals quicker. There's a lot of reasons where we can be wrong with our economic assumption. But I think even if you get a couple of these that come through outside of a vaccine, I think the risks are skewed modestly to the downside, and a reassessment of next year's earnings may need to occur. But because of the policymaker backstop, I don't think the fundamentals, even if they're bad, they're really bad, I don't think they're going to be able to overwhelm financial markets, limiting the potential decline that you're going to see. So obviously, we didn't discuss other issues like trade wars and elections and all of the other stuff that's on the wall of worry. We can certainly talk about that from a Q&A perspective. But again, our view, market's going to be range-bound. The risks are modestly to the downside at this point. But obviously with the backstop that policymakers have put in place, I think there's going to be a limit to how far markets can move down. So with that, maybe I'll turn it back over to you, James, to see if there's any questions in the queue for us.
Yeah, thanks, Jeff. Thanks very much for your perspective. There are some encouraging signals there, particularly with the dashboard turning green, but clearly there are a lot of ongoing challenges as well, and we may see some volatility ahead. I think that's a good segue to look at our poll, which was posed at the beginning of the call, and see what the responses are, please, Rebecca, if you have those. And it looks like we've got a very definitive 100%, 10 to 20%, which falls very neatly into your category, Jeff. Maybe you were the only person that answered.
I feel like everyone has seen this presentation I've given before. I'm clearly part of consensus. I get nervous when I'm part of consensus. I'll just say that right now.
Yeah. Well, how do you? I mean, clearly there's a sense that markets are looking rich. I mean, how do you justify or explain the multiple on U.S. equities right now?
Yeah, well, I alluded to a couple of these issues in my previous comments. One is that the Fed has removed solvency risks for IG credit, and then more importantly, fallen angels. I was really concerned about fallen angels creating a potential contagion issue in the next recession. The Fed has obviously backstopped that risk, but if you have lower solvency risks, the demand for equities, it should demand higher multiples for equities, all things considered. So I think that's one of the reasons. The other one is that the risk-free rate is extremely low, like 60, 70 basis points. And when you try to value stocks, if the discount rate is that low, that should, all things considered equal, push up PEs. Also, if you think about bonds, they're traditionally the biggest alternative to stocks, and with many sovereigns providing little or no yield at all, equities may be the preferred asset class, and it should be viewed maybe beyond fair value on what you typically think of it as a long-term perspective. Comparing valuations from the 70s and the 2020s, for example, like apples and oranges, given the discount rate that you're using there. Also, we have a really good slide that we don't have in here, but in our larger Anatomy of a Recession deck, that looks at the PE composition of the S&P 500 over the past 100 years. And what it does is it brackets the cyclical sectors in one category. So you're talking, industrials, materials, energy, financials, for example. And then it brackets all your growth, stability, and defensive sectors in another area. IT, utilities, staples, comm services, all of those. And it looks at these two areas over time. And recently, you have the most growth, stable, and defensive sectors in the S&P 500 in history. About 75% of the S&P 500 are these stable sectors, these higher growing sectors that typically justify a higher multiple, and only 25% of the S&P 500 are these more cyclically oriented sectors that tend to have greater fluctuations, but more importantly, lower PEs. And this is well above what we've seen throughout history. So if you have the S&P 500 as more of a defensive / growth-oriented type of index, it naturally, if the long-term PE of the market is 16, for example, maybe we should rethink that. Maybe it should be 18, maybe it should be 19. I don't know what the exact number should be, but with the PE of the market being around 20 or 21, maybe it's not that overvalued, all things considered, just giving that composition that we talked about. But I talked about this a second ago. One of my concerns is, again, because analysts have embedded that typical recession into their earnings estimates, and you're seeing high dispersion because there's a lack of visibility. About 200 companies in the S&P 500 have removed guidance. And if you do see the economy come into a lull here, and you do start to see a weaker economy, that certainly could affect what the E is going to be for 2021 and a reassessment of earnings. We're not there yet, but it is one of my bigger concerns.
I mean, with that in mind, what you just said about earnings, what are your expectations for the upcoming earnings season?
Well, if there ever was, if there ever was a kitchen sink earnings season, this is the piece of information into this earnings number, because the markets are going to be looking through the headline number and they're just going to be focusing on guidance, right? I just talked about the fact that close to 200 companies have removed guidance. If you look at how they've performed, as of the end of last week, companies who had withdrawn guidance were down 12.8% on average, with the broader market down 2.1% year to date. So they've obviously been punished by investors, but I think because of this uncertainty, I think that the hurdle rate for Q2 is very subdued, right? Consensus for the S&P 500 has it at negative 45%, obviously the lowest that we've seen since the crisis. But more importantly, and why I think we're going to see earnings beats, is that a lot of analysts, they didn't upgrade their expectations, as you had a lot of data surprises on the positive side, economic data surprises on the positive side, over the last few weeks to months of the quarter. And traditionally, when you have data surprises to the upside, you have earnings beats to the upside. They're very strongly correlated over history. So that's this quarter. So I wouldn't be surprised if you see huge beats. You see a little bit of a rotation into value because of those beats. But I think the real, when the rubber hits the road, is going to be the second half comps. They're going to get a lot tougher. I think it's going to be very difficult for the S&P 500 earnings to hit 35% in QE and then 15% in Q4. again, given this fact that I do think you're going to see a lull in economic activity, and a lot of the Q2 numbers are going to be juiced from that technical bounce that we saw off of depressed levels. So, near term, I think this is going to be a great quarter, but I do see some issues with subsequent quarters as we move through the year.
Yeah, thanks, Jeff. We think about the performance of some of these companies, and we tie that in with some of your economic expectations. A couple of things that have really bounced, or things which we don't think will linger. One is solvency concerns. Another, could be more of a focus on labour weakness, and if that won't linger, what do you feel going forward? I mean, we have a question here that focuses very much on small caps. Why are they underperforming if solvency concerns are reduced, and when do you think they might make a move upward?
Well, no, I think solvency concerns are very much elevated right now for the U.S. economy, right? If you think about small caps, they're much more tethered to the U.S. economy, the health of the U.S. economy, versus their larger cap brethren, right? So a lot of large caps have, depending on which industry you look at, but there's a range of estimates, but anywhere from 30 to 40% of their revenues are internationally, they're garnered internationally. So with the rest of the world coming back online much stronger, they've dealt with the virus in a much more effective manner. That would naturally lead to a better earnings profile for larger cap companies rather than small cap companies as well, that are, again, not that they have no international exposure, but much less international exposure, all things considered. Also, with a weaker dollar, that plays into large cap versus small cap, again, because of that domestic versus international exposure as well. Again, I think the U.S. economy is going to have a very difficult time as we start to come online here, and small caps, again, are just much more higher geared domestically speaking. So I think there's a myriad of different reasons, but I think those are the bigger drivers on why small cap hasn't, had that reacceleration that you typically see over large cap when you have traditional economic and market bottoms coming out of a recession.
Thanks, Jeff. Another question we have here is focused on the Fed, and clearly they've done a lot and have a lot of resources, but how much more can they do, Jeff, and what's the intention as far as you're concerned?
Well, it's a great question. I'm sure a lot of people would have said the Fed wouldn't have pulled out all the programs that they did during the crisis, and they never ceased to amaze me. But maybe one of my most non-consensus views right now is that I think the Fed is going to implement, or there's a strong possibility that the Fed is going to implement yield curve control over the next 12 months. I think they're going to do that because it's going to become more apparent about the damage that this recession is going to cause. And if you look at the most recent minutes of the FOMC meeting, they're leaning more towards enhanced forward guidance, and they clearly did not favor yield curve control. But again, if you think about QE, for example, when QE was first discussed, they didn't embrace it at all, but it became a primary tool of their toolkit as it became more apparent that how effective it is. And I think obviously yield curve control is going to follow the same pattern. Now, obviously, I think with the economy limping along, I think the Fed is going to be under more and more pressure to do something. You don't have an inflation problem, right? We're going to be well below that 2% target for a while. So in order to do more, what can they do? Well, they're going to do enhanced forward guidance. They're going to say something to the effect of, hey, we're not going to raise rates for 2, 3, 4 years. And that's a way of easing financial conditions. And they're probably going to tie it to hitting their inflation bogey over a sustained period of time. They're also going to probably go to QE, maybe commit to increasing the balance sheet at a certain pace like they did with QE3, $85 billion per month, whatever it is. But they'll start off at 40, move up to 60, maybe 80. But there will be some point where they get concerned about the optics of these large purchases. And I think because of that, they're probably going to move towards yield curve control. And it's more effective than QE, but it does come with greater risks because when you do yield curve control, the Fed loses the size of its balance sheet, right? If you're telling people that you're going to buy bonds and bond yields move higher, you have to continue to buy those bonds and your balance sheet can get bigger than what you would like to see. Now, the Fed staff did, back in 2010, they presented 3 variants of yield curve control for consideration. The first is that yield curve control is tied to forward guidance, meaning that if the Fed wanted to keep rates at 0 for 3 years, they would cap yields on bonds maturing from today to 3 years out. And as we move forward, those caps would naturally roll off as the Fed gets closer to raising the Fed funds rate. So this is an easy exit. You know, it's not like we're going to have taper tantrum. You want to have the disruptions along those lines. That, in my opinion, is the easiest to approach and the less risky. The second option is they can target a number of different points on the curve. They can target the 1-year Treasury, 2-year Treasury, 5-year Treasury, several different areas. And the final option would be to target a single longer-term yield, like the Bank of Japan did in 2016 with the JGB. Out of those options, I think they're going to go with option number 1, target the front end of the curve, enhance forward guidance, because the U.S.'s situation isn't really that dire where we need to target the long end at this point. And if you look at Australia actually just recently did yield curve control. And once they established credibility that they're willing to buy bonds and enforce, they actually didn't buy many bonds at all. Their balance sheet actually remained relatively stable. You saw the same dynamic with Japan as well. So, long story short, Jimmy, you never want to, short the ingenuity of the Fed. It can always surprise you that they can do more. And even though they're not saying they're going to do yield curve control yet, I think it's likely going to occur sometime in 2021.
Very good. Thank you, Jeff. I want to change tack now and talk about the elections. How do you see that playing out, and how do you think the markets will react?
Right. So it's hard to handicap the election. I'll say that the scenario that would probably be most detrimental to the market would be a Democratic sweep, right? Democratic sweep, you have higher potential for higher taxes, obviously more regulation on key industries, healthcare, energy, financials, information technology, potential some issues with share buyback activity. And in order to have this Democratic sweep, the Democrats need to take 3 net seats from the Republicans. And right now, if you look at the betting markets, they're saying it's a 50-50 shot of a Democratic sweep come November. Now, there's 2 schools of thought, right? The positive view is that Biden might not actually pull the lever on raising taxes in a weak economy, because if recovery of businesses and job growth are prioritized, it could hurt economic growth, and it actually could hurt their 2022 midterm elections. Also, the positive view is that new government spending could offset increases of taxes should it happen. Also, there's some maybe see some reduction of tariffs on China to negate some of the impact. The other thing that I read that was really interesting, that even if you see increase of corporate tax revenues, it's going to hike from 21% up to 28%, would increase revenues for the federal government of anywhere from $70 to $130 billion in 1 year. I mean, yeah, that's a big number, but it pales in comparison to the deficit, which is going to be closer to $4 trillion this year. So, the effect of the tax increases may be insignificant compared to the damage done to investment and job creation. So that's kind of the positive view. Negative view is that Biden and a lot of Democratic senators have said that they want to raise the corporate tax rate here, even in a slowing economy, right? So they might not necessarily care. The other negative view is that tax increases, they're immediate, while new spending usually takes years to come out. And infrastructure spending is a prime example. When you have an infrastructure project, the stimulus doesn't hit the economy for years after that package is passed. And then also, if you increase the tax rate substantially, it's going to shave 11% off of S&P 500 estimates. It poses risk to profitability, dividends, share buybacks, all of which are typically good for the financial markets, all things considered. What's my overall view? I think it's more of a hybrid view. I think it will be difficult for the Democrats to raise taxes in a weak economy, but I do think you will get tax raises, but I do think it will be watered down from what has been talked about on the campaign trail. I don't think that there's going to be reduced tariffs on China. I do think that playing tough against China plays well politically on both sides of the aisle. So I don't necessarily think that the new administration with Biden at the helm, that the relations with China would miraculously get better. I think it could get better with Europe, but I think with China, I think you're going to continue to see some pressure on that front. But all in all, I think that you could see the market maybe pull back 5 or 10% from a Democratic sweep type of scenario.
Okay, do you have any more details? A question here on U.S. trade wars and the impacts on that on markets. So a bit more flavour on the direction that might take.
Yeah, so I guess you have kind of two wars or two theaters, if you were. You have the Pacific theater and the Atlantic theater for talking about the war here. And let's just say the Atlantic theater, obviously things have gotten dialed up here recently on two separate issues: digital service tax and then the issue on the Airbus subsidy case. Now, if you think about the digital service tax, the U.S. Trade Representative has opened 10 Section 301 cases against countries over their plans to impose the digital service tax. Earlier this week, you saw the U.S. hit French goods with 25% duties with cosmetics, handbags, for products valued around $1.5 billion in response to the digital service tax that France had put into effect. The key here is that it delayed the effective date. The U.S. delayed the effective date 180 days. So we have basically 6 months to be able to iron out the details to make sure that these tariffs don't come to fruition. And also with Airbus, this has obviously been going on well before the Trump administration. This has been decades almost in the making. And you are seeing new tariffs being proposed potentially against a couple of European countries, with tariffs going as high as potentially of 100% because of the progress, or the lack of progress, I should say, of European subsidies. But all things considered equal, I think this is just small brush fires. I don't think that these are anything material that can really disrupt the market's broader behavior. Obviously, if your goods go and tariffs or have duties put on them, that certainly could affect individual companies, but I don't think that there's going to be much more waves than what we've seen right now. The other thing is obviously China. Obviously China, Trump had mentioned recently that he's not pursuing a phase 2 trade deal. That's really not surprising because, there's a lot of aspects of phase 1's deal that aren't actually fully addressed at this point. China has been much better in its intellectual property protections. It's actually liberalized some key markets with Visa and MasterCard, Amex, for example, getting access to Chinese markets. But they have not been as able to import as many goods that was signed on with phase 1. China was expected to bring on $200 billion worth of exports, more exports over 2 years. Right now, they're at 25% of their import targets this year. And a lot of that, obviously, is because of the COVID-19 shutdown. So with obviously not executing fully on phase 1, it was just a natural progression that phase 2 wasn't going to move forward at this point. But the key here is that I don't think you're going to see a massive escalation in trade tensions with China because of two reasons. First, the U.S. continues to have a reliance on the Chinese supply chain for COVID-19, right? Whether it's medical supplies in the short term or a vaccine in the long term. There's less reliance now than there was in say, February, but again, there's still a reliance there. But also the administration's not going to want to upset the economy heading into the fall elections. And if you look at all U.S. presidents, there's only been 3 that haven't been reelected for a second term. It's Carter, Ford, and H.W. Bush. And those were the 3 presidents that saw a recession within 2 years of Election Day. And they're the 3 presidents that saw a material rise in the unemployment rate the year of the election. And obviously, we've had a recession. We've had a rise in the unemployment rate. But if you see a ratcheting up of trade wars, that would not bode well, I think, for the re-election of President Trump. So I think it's more smoke than fire on that front. But I do think as we get through the election, things are going to get ratcheted up again with no political pressure for 4 years.
Yes, just taking you back to your comments on China. We've seen Chinese equities move higher recently. Do you think that's sustainable?
Chinese equities have moved higher, really? They always said that there's no bull market like a Chinese equity bull market, and this is obviously the price action that you've seen here. Chinese A shares, they've moved up dramatically off of the bottom, but they're nowhere close to a overshoot, like the extremes that we saw in 2007 and 2009. In my opinion, this is more of a mean reversion rather than an overshoot. And maybe to put that in perspective, if you look back in 2015, when you had the kind of last Chinese bubble mania, if you will, the Chinese stocks were trading at 25 times earnings, and the economy was going through a pretty rapid deceleration, where there's fears of a Chinese hard landing at that point. The PE of the Shanghai Composite Index today is not 25, it's 15. And the economy is showing clear signs of recovery right now from the recession. So I think Chinese authorities learned a painful lesson from 2015, and they've done some cooling down signals, like they're regulating their OTC margin financing. They're putting a cap on new fundraising. They certainly want to see a stock market rally because it will help consumption. It'll help recapitalize their banks and SOEs, but they want it to be much more of a measured move higher rather than the move higher that we've seen here. So I wouldn't be surprised if you see a little bit of a cooling here, but I do think longer term that this rally has some more room to run on the upside, given the abundant liquidity and the better than expected macro data that we've seen.
Okay, that's great, Jeff. I think we've got about 5 minutes left, so I'm going to ask you 2 more questions. The first is regarding COVID and the timeline for a vaccine. And clearly there may be some hurdles, but what do you see in terms of a timeline for the COVID vaccine?
Well, we've got 130 best hockey players on the ice, so we're getting a lot of shots on goal, and obviously that's positive. We saw obviously some really good headlines today from Moderna. Also, there's a really good article about Oxford's vaccine. And more importantly, we are starting to manufacture the most likely candidates for vaccines, the 4 most likely candidates at the end of the summer. Being able to manufacture this is huge because, if you think about manufacturing billions of doses of a vaccine, you need to not only get the equipment, you need specialized glass vials, potentially syringes. It's a very difficult type of situation to be able to put that manufacturing capability together. So we're in front of that, which is a really good sign. Also, our healthcare team at CBI, which ClearBridge is one of the best in the industries, in my opinion, and they're optimistic for a vaccine sometime in early 2021. So I think we're making progress. There's certainly a lot of hurdles potentially to hit. Safety issues are certainly a hurdle that we need to be able to overcome. Usually when you think about vaccines, it takes decades, not years or months to be able to come out with a vaccine because you're administering this to a healthy population. And the last thing that you want is something called immune backfiring, where some of these vaccines can actually amplify the effects of a potential virus. You saw that with dengue virus a couple of years ago, where one of those vaccines, if you get a different strain of dengue virus, it actually amplifies the effect of that disease, making it life-threatening. You also have the potential for a mutation. We saw a couple of mutations from a study done at Arizona State, also Los Alamos. This does appear to not mutate very quickly. Our healthcare team feels like a mutation isn't a high likelihood, but it is certainly a concern. But also the nightmare scenarios if we don't achieve herd immunity, meaning if you get the measles, for example, or chickenpox, you get that once, you're immune for life. A lot of coronaviruses, you can get immunity, but that immunity goes away, or those antibodies go away over a 3, 6, and maybe a 1-year timeline. And the hope, and this would be the nightmare scenario, is if we get a vaccine, if that vaccine wears off and your immunity wears off over the course of a year or maybe 2 years, and people would have to get inoculated time and time again to be able to protect against the coronavirus. Again, these are all not our baseline scenarios, but they are potential hurdles that obviously people should be aware of with a vaccine. But our base case is early 2021 for a vaccine.
Okay, that's a long way out and longer than some. One last question, Jeff. We've just got a few minutes, and I just want to focus on your dashboard and some of the data points that you're looking at. In your opinion, what's the most important indicator on the recovery dashboard? Are there any other data points that you're watching and that people should be looking out for?
So, yeah, the dashboard, I'll just get to the dashboard slide here really quickly. Bear with me 1 second. So the dashboard, we're all equally weighted. So, we don't necessarily think one is better than the other, but depending on the source of the recession and the backdrop of the economy, there are ones that I think are, canaries in the coal mine, if you will, or, beacons for what's the likely path of the recovery. And I think this one time around, it's jobless claims. I talked about how jobless claims are still elevated 3 months after, or 4 months, I should say, after lockdowns started to occur. We're at double the previous record, basically, that we've seen in the U.S. A lot of these layoffs are going to be permanent, and they could be a window into a lot of the bankruptcies and pains that U.S. businesses are feeling right now. So that it would obviously be the one that I'm monitoring the most closely. What I'd hope to see is that by middle of August, if we can get jobless claims down to what you would normally see in a deep recession, if we can get 650 or 700,000, which again was the previous record, but if we can get down to those levels by the middle part of August, I would be really happy. If we're still in the 1 million range, 900,000 range, 1.1 million range, that's a very bad sign that the economy is going to take much longer to come online, but more importantly, there's sustained damage that's taking place in the U.S. economy. A couple of other things that I'm watching, hospitalizations and deaths. I think with deaths now moving higher right now and health systems starting to become taxed, these data points are going to be great barometers into the likelihood of states either stopping or pausing the reopening or retrenching, and it does have important implications for consumer spending. Another one will be home-based data. If you're not familiar with this, home-based is a great way of seeing the health of small businesses around the country and whether or not growth is stagnating or recovering. And in home-based data recently in the South and the West, you're actually starting to see a lot of the data decelerate here with the increase of viruses that you're seeing there. And then last but not least, Dallas Fed has a mobility index that, again, it tracks things like people's interactions with the economy. You're starting to see a deceleration in the South and West as well. And then also open table, just trying to see how many people are going out to eat as a good barometer of the engagement with the economy. So a lot of kind of secondary data points that we look at ClearBridge, but the most important one from the dashboard perspective is jobless claims.
Thank you, Jeff. Thanks for that, and thanks for your perspectives. I'm afraid we've reached time on the call, but if there are additional questions, please do contact your ClearBridge representative and we'll respond with the information that you need. But thanks again to everyone for attending the call. Thank you, Jeff, as well, and we hope you all enjoy the rest of your day.
Thanks, everybody.
Thanks to all of our participants for joining us today. This concludes our webcast, and you may now disconnect. Have a good day.